สวัสดีครับผมชื่อเคนนากาโนะมาจาก Nomura Asset Management ขอบคุณสำหรับคำเชิญผมมาที่นี่ผมหวังว่าทุกท่านคงสบายดีนะครับ Now please allow me to make my presentation in English. Now, let me start off my presentation with a question for the audience. Do you know what's the fastest way to make investors fall asleep at conferences such as the one we are attending right now? Any guesses? No? It's when the guy standing at the podium starts talking about Japanese equities. No joke, it works like anesthesia. Post-Abenomics, I have probably been putting more investors to sleep than getting them to invest in Japanese equities. So my ultimate goal today is to keep the audience from nodding off to a late morning nap. And I promise I'll keep it as exciting and fun as possible. Now, speaking of exciting, I'd like to first and foremost start off by thanking our wonderful host, BBLAM, for inviting us again to this wonderful conference to talk about Japanese equities. My boss was actually here at this last BBLAM conference to talk about Japanese equities. And if you were there and you took his advice and invested in Japanese equities, you probably made some money. I just hope that you invested in local currency. If you had taken a position of long Japanese equities and shorted the Japanese yen, you probably made some real money. Good for you. Now, before I came on the stage, I learned that BBLAM has a slightly overweight neutral rating towards Japanese equities. Now, with all due respect, BBLAM, you just made my task of keeping everyone awake an uphill battle. But I hope that after you listen to my presentation, you'll kindly reconsider and give an overweight, strong overweight to Japanese equities. Now, a lot of global investors do not share our enthusiasm for Japanese equities. I don't blame them. Because when you look at the presence of Japanese equities within the MSCI World Index over the span of the last 2 decades, 23 years ago at the turn of the century, it was 13% of this index. Now, it's only 7%. When you go back in time to 1987, Japanese equities was 40% of the MSCI World Index. Now it's 7%. Now, this is understandable given Japan's structural issues. The country has become basically a poster child of an economy with chronic inflation since the 1990s, lackluster corporate earnings growth, and poor focus on shareholder value. So it seems that Japanese equities over the years have somehow been lost, neglected, and outright forgotten by the global investment community. Oh, come on, Ken, you're over-exaggerating. Japanese equities forgotten? No way. BBLAM wouldn't be inviting you to this stage if no one was interested in Japanese equities. Well, let me tell you a story, a true story. Now, I am a fund manager by trade, so I usually don't have the luxury of coming to conferences such as these and speak to wonderful audiences like yourselves, but I do have the opportunity to talk to global sovereign wealth funds and institutional investors. Now, this was around 2016, few years after Abenomics, and I think everyone remembers 2016. It was a bad year for global equities. Chinese economy tanked and brought down the global equity market with it. Now, I visited this one particular institutional investor and pitched them the idea that it's a great time to invest in Japanese equities. I remember saying something along the lines of, Japanese equities are super cheap, pennies on the dollar, let's go. I didn't say it like that, but I think the investor understood where I was coming from, could feel my enthusiasm. But the investor wasn't convinced. He said something like, well, Abenomics, Ken, was a great play. 3 arrows, simple, straightforward. We made a lot of money. But investing in Japanese equities over the long term? Come on, you gotta be joking. I got the cold shoulder, but I'm a pretty positive guy. At least he didn't fall asleep on me. Next year, I go to the same investor, pitched him the same story. Japanese equities, still cheap. And he laughed and said, Ken, that was your pitch last year. You have to realize, Ken, at some time that Japanese equities are cheap for a reason. Got turned down again. Then something wonderful happened. Warren Buffett, the Oracle of Omaha, took interest in Japanese equities, more specifically, Japanese trading houses. And when we heard that Berkshire Hathaway, Warren Buffett's company, started investing in these Japanese trading companies, portfolio managers in Japan, like myself, we looked at each other and said, has Warren Buffett lost his mind? Because if anyone knows anything about Japanese trading companies, is that it's nothing more than a value play. No clear competitiveness, no potential growth, and the trading companies will burn through cash, spending it on low ROA investments. And there were obviously no signs of these companies expanding their shareholder return policy. But Warren Buffett proved to be right. After Berkshire Hathaway invested in these trading house names, their share prices went through the roof. Some say it was the Buffett effect. And what the Buffett effect is when Berkshire Hathaway invests in a certain company, that information is disclosed to the public, and other investors, individuals, sort of hop on ship and effectively drive up the share prices. Now, I wouldn't disagree with that argument, but if you consider the fact that after Warren Buffett bought these trading houses, their profits doubled, and these companies rolled out unprecedented shareholder return policies. So from a corporate fundamental perspective, the share price appreciation can be justified. And this makes me think about how the global investment community should embrace Japanese equities. As the market adage goes, price is what you pay, value is what you get. And I think that Japanese equities, not just these trading house companies, fits this quote perfectly. Now, Japanese equities do not offer sexy stocks such as Google, Amazon, or Apple, or Tesla, but that doesn't mean that there is no value in Japanese equities. And when that value is unlocked, just like how Warren Buffett did for the trading companies, the upside return is huge because over the years, again, Japanese equities long been lost, neglected, and outright forgotten. I mean, who doesn't get excited when they discover a stock with great cash flows, strong competitiveness, and no one on the street is talking about them? Well, that's sort of the feeling that you get when you're investing in Japanese equities. It's like a treasure hunt. People ask me, why Japan, Ken? Why? And I tell them, why not Japan? We at Nomura Asset Management, we have a few reasons why we like Japan. One, it's emerging from a deflationary state that has continued since the 1990s. Two, we think that Japanese equities can benefit from geopolitical tensions that have been mounting of late. And three, there are changes taking place on the corporate side, especially corporate governance. But the key underlying word across all three of those reasons is change. Japan and Japanese corporations are changing, and we believe that it's a good time to revisit Japan, especially when the world is changing rapidly. The world we live in changes rapidly. You don't need me telling you that, but the paradigm has changed so dramatically over the last few years. It changed when Donald Trump became the president of the US. It changed when the coronavirus pandemic broke out. It changed when Russia decided to make its move on Ukraine. And it changed when Hamas launched a cross-border attack on Israel and reignited the Middle East tensions to levels that we have not seen since the Yom Kippur War back in 1970s. These events have caused a chain reaction of how the world will be shaped in the future. And as the world is changing, so is Japan. So let's start off with our first topic. Japan has been, for the most part, been in a deflationary state over the last few decades. Now, that all changed when the coronavirus and the Russian-Ukraine war broke out. And all of a sudden, we were faced with a strong upward surge in energy and food prices. In Japan, like other countries, inflation first started to increase due to increase in import prices, and this was due to the disruption in the global supply chain. Then it gradually spread to other items. And let me tell you, Japanese people, they're so used to deflation that they go absolutely nuts when the price of, for example, bread goes up. My mother called me at work to tell me that the bread where she usually buys her groceries went up significantly from the week before. My mother is a little bit crazy, and you know what she told me? She told me that she was gonna go across town to look for cheaper bread. And you know what I said? I said, Mother, the cost of you going across town is much more expensive than the bread itself. So you get the picture. People go absolutely nuts when prices go up. But in situations like this, you can imagine what the average consumer would do. They switch. They look for alternatives. They start looking for cheaper bread. But as time wore on, inflation became more widespread. There was no more cheaper bread. And you might be saying, Ken, this isn't real inflation. This isn't the inflation that we want to see. This is cost push. And you're absolutely right. Since the mid-1990s, Japan's consumer price index, excluding food and energy prices, has never hit that 2% target. It increased above 1% 2 times, and that was in 2008 and 2015. Both of those times were due to cost push. So how is this time any different? Well, I'm no economist, so I don't have a sophisticated model to tell you if this inflation is sticky or not. But I am a fund manager, and I believe that one of the best ways to measure if this inflation is sticky or not is to look at the corporate side. I'll give you an example. Japanese food companies. Japanese food companies are traditionally reluctant to raise prices, even in times of temporary inflation, because they care more about market share than they do about bottom line profits. And that's why, as a fund manager, I've stayed away from investing in Japanese food companies. But since inflation has been so rampant, these food companies had no choice but to raise prices. And when one company started raising prices, all others started to follow. Now, I won't say that in the past, food companies in Japan never raised their prices, but because they did, but not many followed to raise prices. They didn't want to take that risk of losing market share. However, in the light of the recent inflation, even the super reluctant food companies have started to raise prices and are caring more about profit margins than they are about their market share. So we believe, inflation has triggered a change in the corporate mindset. Now, is inflation going to get out of hand? Now, we at Nomura Asset Management, our in-house economists project that inflation has peaked and will likely come down to 2%. But there are other inflationary factors at play that Japan faces today that could potentially keep inflation elevated and a bit more widespread. So let's look at the labor market in Japan. Everyone knows that Japan's population is declining. Although the working age population has decreased by 10 million people over the last 2 decades, as you can see on the left-hand side of this slide, the labor force has actually been pretty resilient. And that's because the labor force participation rate of the elderly and the females have gone up significantly. If you look on the right-hand side, the participation rate of females between the ages of 15 to 64 is actually 75%. The elderly, 65 years or older, it's 63%. Now, how high can this participation rate go? Now, it's hard to say, but there are external forces that is helping facilitate more workers and the elderly workers to enter the workforce. For example, the idea of ESG, which calls for more diversity in the workforce, or the corporate boardroom. This has created more opportunities for female workers. There's even the idea that having a workforce made up of exclusively of elderly people is better because it creates a more peaceful work environment and gives consumers more comfort. And I kid you not, there is a Japanese hamburger restaurant in Japan that intentionally hires the elderly just for this reason. And the idea behind that is because when you get served hamburgers by someone that could be the same age as your grandfather or grandmother, you just feel a little bit more comfortable. Now, there are lots of data points that suggest that the labor shortage is really severe. Here on this side, we see the job opening ratio for full-time and part-time employees. The two ratios haven't crossed paths since the 1970s. On the right-hand side, you'll see the diffusion index of employment shortage surplus is on the rise. There's just a massive shortage of labor all around us. Now, the labor shortage is so severe that it's even bankrupting companies. Now, the data on the right-hand side is for companies only, the number of companies that have gone bankrupt. Imagine if you consider the number of individually owned restaurants or mom-and-pop shop stores going out of business because they can't hire people, the number is much more staggering. So how do we tackle this problem? Well, robots, right? We're increasingly seeing more companies deploy robots to help alleviate the shortage in labor. Robot density is on the rise. But don't think for a moment that these cute robots are running all over Japan making up for the shortage in labor. It's becoming more commonplace, but robots alone will not solve the labor shortage. Given the severe labor shortage, we believe that the strong wage growth is way overdue. Shunto, which is the spring wage negotiations that takes place once a year in Japan, shot up close to 4% this time, which is something that we have not seen for the past 2 decades. Another key evidence that inflation may stay high. Labor shortage is something that you cannot fix in a couple years. Further increase in the participation rate of the elderly and the females, as well as the increased use of robots, will help the problem, but there are limits. At Nomura Asset Management, we believe that the participation rate from 2024 onwards will start to decline gradually. Given this structural problem, we believe that wage growth will continue to increase going forward and will keep inflation entrenched and at the same time facilitate a change in the corporate mindset as it did with these Japanese food companies. Let's move on to the next topic. Japanese equities, a beneficiary of geopolitical tensions. What do we mean by that? Well, ever since the US has made it clear to the world that their top priority is to contain China from growing any stronger, the world has been hit with regulations after regulations. Diplomacy seemed to be a bit more civilized in the past. Countries would run together, officially pushing each other, but there was still a degree of sportsmanship. Nowadays, countries are running together, but intentionally sticking out their foot and trying to trip each other. In recent years, we have seen restrictions, regulations, rise in economic nationalism, populism, and countries are prioritizing supply chain resiliency over supply chain efficiency. And it seems like we have to wave goodbye to globalization. So this paradigm shift shows up everywhere. For example, on this slide, you can look at the total US non-residential construction spending, which has skyrocketed in the last few years. Even Mexico's gross fixed income formation has been going through the roof. In order to minimize their reliance on China, US is building factories domestically, China is building their own semiconductor supply chain, and even Japan has joined in on the party. Who benefits from all this? Well, companies, obviously, mainly manufacturing companies, because the supply has never been more important than the demand side. The reconstruction of the supply chain, global supply chain, is unfolding before our eyes. Now, we see this having an impact on individual companies. For example, Disco. This is a company that makes equipment used to assemble all types of semiconductors. This bar chart on the left, it's their quarterly shipments. Their shipments before 2018 was no more than 33 billion per quarter. Now it's double. Look at Tokyo Electron, another company that manufactures semiconductor equipment on the right-hand side. They compete with the likes of Lam Research and Applied Materials. Now, this bar graph on the right shows Tokyo Electron's quarterly sales to China. Usually, sales correlate with semiconductor prices, in this case, memory. But recently, even though the price of memory has gone down, Tokyo Electron's sales to China has actually been going up. So these are some of the signs that we are seeing on a company level. Even the Japanese government is intent on rectifying the domestic semiconductor supply chain. Major investments are underway and in progress. So the signs are everywhere. Now, geopolitical tension is not good for the world, but it's definitely a tailwind for the Japanese manufacturing sector. And if you want to capitalize on this play, there are abundant of stock ideas and themes in the Japanese equity markets that will potentially make you some money. Now, despite the mounting geopolitical tensions, though, the state of the Japanese economy is quite resilient. For example, the domestic loan demand has been increasing, and private capex robust as well. Loan demand isn't strong because factories are popping up everywhere in Japan. Loans to the manufacturing sector as a percentage of total loans is actually 3 to 4% of the total loans. So it's actually the non-manufacturing sector whose demand for loans are quite strong. And that's partly because companies have to invest in their IT infrastructure as well as their labor force to increase the productivity of their workforce. Now, the business cycle is also strong. This is compared to other developed countries. We expect Japan to post positive growth throughout this year and also in 2024. Now, compare that with the US or the EU, where the economic growth is expected to lose some steam going forward. Last but not least, Japan offers a bit more stability when it comes to economic policy, as you can see from the line graph on the left, the Economic Policy Uncertainty Index. So in a world where geopolitical tensions are high, investing in Japan might just be a safer bet. Now, the last topic for today. By the way, I'm glad that everyone is awake. Now, let us look at some of the changes that are happening on the corporate side of things. So let's just start off with some basic facts. Now, global investors are surprised when they see this chart on the left because they think earnings growth of Japanese companies have declined over the years, when in fact is quite the opposite. This chart actually shows the corporate earnings growth of Japanese companies since 2003 and has basically been on par with their US counterparts. The next slide shows you the number of companies in the Tokyo Stock Exchange and the S&P 500 whose return on equity, ROE, is 12% or higher. In the S&P, out of the total constituents, the percentage of companies whose ROE is 12% or higher is 61%, while for the Tokyo Stock Exchange, it's about 31%. So it's very obvious that percentage-wise, more companies on the S&P 500 offers good return for investors. But in terms of the number of issuers, it is S&P's 290 issues against Tokyo Stock Exchange's 564. So there are more companies offering ROE of 12% or higher in Japan. Let's look at their valuations, and this is on the right-hand side. When you look at the valuation spectrum of the 12% or higher ROE companies in both the S&P 500 and the Tokyo Stock Exchange, we find that about 75% of the companies with ROE of 12% or higher is trading at a PER of less than 20 times in the Tokyo Stock Exchange. That means you can buy cheap, high ROE stocks in the Japanese equity market. But the real question is, are these companies actually delivering returns? And the answer is that yes. The performance of companies with ROE of 12% or higher has mostly been on par with the S&P 500 returns. And again, the valuations, as you can see on the right, it's much more cheaper than the S&P 500. So delivering strong returns and cheap is the best way to describe some of these stocks. And as Warren Buffett said, price is what you pay, value is what you get. Now, I've given you the basic facts. Let's look at some of the changes that we're seeing in some of these Japanese companies. One is shareholder return. Ever since the introduction of the stewardship code and the corporate governance reforms, corporations have made massive strides in improving their capital efficiency. The pace of share buybacks remain at historical highs. But this trend sort of sends mixed messages. Why? Corporate Finance 101. Why do companies buy back their shares? Two reasons. One, companies think that their share price is undervalued, so they use the cash on hand to buy it back. Two, the other reason is that companies have excess cash on hand, but they don't see any potential investments for growth. So rather than spend that money on a project that could possibly yield negative return on investment capital, they rather return it to shareholders. Now, one thing that I will tell you as someone that meets with over 200 companies per year is that I've noticed that more Japanese companies are paying more attention to their cash flows. And when you pay attention to cash flows, that naturally leads you to become more aware, more conscious about your capital allocation policy. So my theory is that companies are buying back shares not because they think that their shares are cheap or there's no investment prospects. It's simply that they're paying more attention to their capital allocation, and in that process, simply realigning their uneven balance sheet. Simple as that. Another change that we're seeing is more transparency. For example, unwinding of cross-shareholdings. Over the last few years, the percentage of cross-shareholdings have declined, which is good, but there are still companies like Toyota who have been stubborn about this idea. But recently, Toyota is changing. Toyota actually have made massive strides in unraveling their cross-shareholdings and make more effective use of their assets. Another huge change. One thing that I can tell you about companies, especially the large ones in Japan, is that they look to their left and they look to their right to see what everyone else is doing, especially the big guy that holds the most influence, like Toyota. So when I say that Toyota is unraveling their cross-shareholdings, that sets off a chain reaction of other companies with the same problem looking to do the same. The boardroom is changing. Even though Japan is still at the bottom in terms of ratio of female directors, compared to other countries, it has improved quite a bit. And who can forget about ESG? Seems that everyone loves ESG. Now, it's an important metric in the financial world these days. But let me give you my honest opinion about ESGs. And I'm going to go a little off script here. And I just saw my colleague's face shoot straight up. I won't say anything crazy, and that will get us in trouble. But I get annoyed when investors come to Japan and tell Japanese companies that they're not ESG friendly enough. The G part, the governance part, yeah, I'll give it to them. That part's a little weak, yes. But the idea of ESG has always been ingrained in Japanese companies. They just didn't call it ESG. They called it Sampoyoshi, which is a philosophy that advocates the benefit to all parties involved. And this has been a philosophy that has been around since the Edo and the Meiji periods in Japan. That's 400 years ago. So I like to say that Japan has been ESG sort of friendly from almost 400 years ago. Unfortunately, Sampoyoshi is not a philosophy that doesn't translate well onto ESG scores, and the distribution of ratings, ESG ratings, is still not on par with other countries, but we at Nomura Asset Management believe that as more Japanese companies start disclosing more information, that will help their ESG scores in the future. So lots of good change happening in the corporate world. In the remaining time I have left, allow me to talk a little bit about some of the market reforms that are taking place. One, the Tokyo Stock Exchange announced that it's going to require listed companies to disclose their strategy in raising corporate value on a sustainable basis. And this is also one reason why share buybacks have actually continued to increase, because corporations are reconsidering their capital allocation policy in order to meet this requirement. Price-to-book ratio is one metric that is used to monitor corporate value. So naturally, companies that have a PBR of less than 1 are pressured to make some changes. And when we look at the distribution of companies by PBR and the percentage of whether they have disclosed any sort of initiative to enhance corporate value, we see that the vast majority of them still have not disclosed their strategy. Various reasons for why that is, but to me, that sounds like a lot of opportunity here. Another market reform that is about to take off is the new NISA program that will begin in 2024. NISA is an individual savings account which allows individual investors in Japan to invest tax-exempt. The government is expanding the amount you can invest in this program. As you may know, 50% of the Japanese household assets are held in bank deposits. With the introduction of the new NISA program, this could incentivize individuals to invest more in Japanese equities. So let me wrap it up. There's a lot of changes going on in the world. Japan as a country, its corporations are undergoing change as well. In the investment world, we all know that asset prices move because of changes in the underlying fundamentals. Now, we at Nomura Asset Management sincerely think that the changes in the Japanese equities that we are seeing unfold before our eyes is definitely worth taking another look at. And hopefully, you can benefit as well as the value is being unlocked. Thank you very much.